Good evening, everyone, and welcome to our webinar series. We have an amazing guest today, Chris Miles, and the topic for today's presentation probably going to attract a lot of folks. I know many of you cannot make it as we're making this recording at the 7 p.m. Eastern, but most of you will be listening to the recording, so I'm sure you will enjoy this, and I'm going to give the floor to Chris. Chris, welcome.
Hey, I appreciate having me here, Alina.
Sure, right. We're excited to have you. Why don't you start with a little bit about you, some bio, and then dive into your topic because everyone is thrilled to hear about it.
Yeah, absolutely. Actually, I'll already pull up my screen since, you know what, I've kind of got that little prepared as well. So yeah, excited to be able to see you guys here today. I know, various of you guys are on here right now. And I definitely appreciate the friendship I've had with Mike over the last several years too. So definitely excited to be here. So as you'll start to see here, I'm pretty much an anti-financial builder, right? So I don't raise fund. I don't have a fund like Mike and Alina do. I don't raise money or capital. I really come off as being more of a consultant, right? I also have a podcast that I do called Chris Miles Money Show. I've had Mike on there before. Mike's had me on his show. It's been fun to be able to do that. But really the topic tonight I want to talk about is how to get your investment money to pay you twice, right? And I know this is something that Mike and I have talked about because Mike was doing something similar to this even from before the time that we met. He was doing this more from a long-term retirement type perspective when you hear things like infinite banking, right? I'm going to talk about how to actually use this now. So you make money with it now, not something in 20 years or so, but something you can do right now to actually double dip on your investment returns. And so a little bit about me. I live in Utah. We were just talking about that before we went live here. Most of the year. I do snowbird in the wintertime because my wife is from the tropics. She's from Venezuela and Florida. So she said, Chris, if we're going to get married, we've been married now for 5 years. It's like, there's no way I'm going to do another Utah winter. So we got to go somewhere south for the winter. So we've done everything from California, Hawaii, Arizona, Florida, Texas. I think this next year we're looking to do it's like South Carolina. So just trying different places, just explore, a little bit more and get away from the cold and the snow. So if you guys are skiers, you're probably heading out to Utah and we're leaving at the same time. We've got 8 kids between the 2 of our families. I've got 6 and she's got 2. So therefore she definitely has to love me a lot more because it was a bigger adjustment going from her going to 2 to 8 than for me going to 6 to 8. I've been financially independent twice by the time I was 39. First time I was actually able to get out of the rat race, as Kiyosaki would call it, was when I was about 28 years old back in 2006. After I quit being a financial advisor of the mainstream. So I actually was a financial advisor from the early 2000s till 2006. Quit that when I realized that financial advising in the traditional form was not working, that you can't get there just investing in mutual funds. So I quit that, started doing more things with real estate, was able to be financially independent when I was 28, then went the recession, got back in the rat race again. I went from millionaire to upside down millionaire. I had to dig back out of that hole, didn't file for bankruptcy, but I did have to dig out of that $1 million+ debt hole. And I was able to become financially independent the second time when I was 39 back in 2016. And so that's where I am today. Now I'm essentially working part-time in my own business. I have my podcast and that sort of thing, really focusing on, infinite banking and then cash flow consulting, helping people map a game plan to get out of the rat race. And I'll tell you, with Alina and Mike, I mean, you guys are one of the funds that we talk to our clients about as ways to grow their money in the alternative space outside of just doing the traditional mainstream, crappy, high risk, mediocre returns in the mutual funds, right? So let's talk about this double arbitrage, or this double dipping effect, right? That's kind of the big thing we're talking about here. And it's about acceleration of your money, not just accumulation. Remember, we go away from trying to accumulate money over the long haul. We're trying to figure out how do we accelerate and create wealth today, right? The problem is that most people just don't get it, whether it's financial advisors, people like the Dave Ramseys of the world, right? Even financial experts, they just don't understand how this really works, especially if you do it well. And just know that when we're talking about things like whole life insurance, whole life is not created the same, right? It's definitely not the same here. So these guys don't get it, but I'll tell you who do get it. It's the banks. They've been using it, right? Banks have been using this strategy for years. In fact, even during the last recession, it's fascinating to know that even companies like Wells Fargo were putting about 23% of their money into plans just like this. They were storing cash in here, almost as their, I wouldn't call it a rainy day fund, but it's really like their war chest. They were building it up, trying to build some stability in what they were doing. And even I'm trying to remember what it was now. It's no longer around, but or they got bought out by another bank. But I think it was Washington Mutual. I think they had up to 42% saved up in theirs during their last recession. So they've been since, I think, bought out by another bank. But any case, I mean, banks have been using this strategy for years. Even Walt Disney used this when he purchased his land in Orlando to develop Disney World, right? So it's definitely not something that's a first-time thing. Now you have two options with cash. You can either pay things in cash, you can use cash, even when it comes to investing, or you can borrow cash, right? That's really what it comes down to. Either you're using your own money or you use somebody else's money when you want to try to create wealth and invest with it. Here's the thing though, is that you're always paying interest. Now this was a foreign concept to me before too, because many times people would say, wait, how am I paying interest if I pay in cash? Because we all get it. If we borrow from a bank, let's say we take out a HELOC, we take out a home equity line of credit and invest it into an investment, we know we're paying interest on that money. But how are we paying interest on the cash? Well, it's pretty simple. Say that you have money in a savings account, right? Say you've got, 250,000 saved up there, and that 250,000 is burning a hole in your pocket. You want to get it deployed. Well, once you deploy that money, say you take that 250,000, you liquidate that savings account and you throw it into an investment. Well, yeah, that money's making money over there, but the money's not making money in the savings account because it's gone, right? Obviously, when the money's out, it's gone. There's an opportunity cost of what that money could be doing. So the question is there a way that we can still have money in savings earning interest and at the same time earning interest in the investment too? Just like if you were doing the fund with Tempo Growth Fund or the Income Opportunity Fund that you're doing, right? Whether you're doing one of those two, could you still be making money there and the money in a savings account at the same time so that you're earning interest in two places at once? So let me describe what that means, right? The key concept you have to understand for this to work is you got to understand compound interest versus simple interest. So I'm going to use an example, just using the most basic loan that probably a lot of us have, if not all of us on this call, right? Say that you have a $300,000 mortgage at a current 3.25% interest rate. So a decent interest rate, not the lowest you could probably get, but it's decent. 3.25% mortgage over 30 years. If you just paid the minimum payment, it would cost you $170,000 more in interest above the $300,000 that you paid on the mortgage, right? And remember, I was a mortgage broker in the mid 2000s. Even when I was a financial advisor, I was also a mortgage broker. And I'd show that truth in lending statement that shows how much you pay total in payments over those 30 years. And I would tell people, hey, if you want to stick it back to the bank, pay off this loan faster, pay it off quicker. Why did I teach that? Because that's what the banks taught me to teach. Now, why do the banks want me to teach you to pay it off faster if I'm a mortgage broker? Because you think they want to earn interest, right? Well, we already know they're going to arbitrage that money. They want to earn interest. And here's the thing. For every dollar you pay in extra principal, they can loan out 10 times that. They can loan out $10. So they want you to pay back more principal faster, which is why they show you this number to scare you. So the question is this, because the best case scenario, I mean, putting a little extra on your mortgage payment isn't going to save you that much in interest. As much as they try to report it to be better, it's not, right? But the best case scenario is you save $170,000 in interest by paying it off today, day one. So let's take that example. What if you had $300,000 that you could cash out from different areas to pay off your mortgage today, but instead of paying it off, you decide to invest it? And what if you invest it earning just say 2%, right? Now, this is where I'm going to ask you guys to use the chat because I know there's a few of you on here, and Lena, you can participate as well. So remember, you got $300,000. Say that you put that into a 2% CD, a crappy little CD at 2%, way worse than a Tempo fund, right? You put in at 2% for 30 years. What do you think that 300,000 will create in interest? Not the total balance, but what would the interest be you think that you'd earn over 30 years on 300,000 at only 2%? Remember, 3.25% is going to cost you 170,000. So what do you think 2% will earn you in interest? So let's just go ahead and see what the people say in the chat here. Don't be shy. This is like the Price is Right. Somebody can bet $1 if you want to do that.
So essentially, you'll have a negative interest. You'll be in the negative.
You'll be earning less interest. Yeah, the interest rate is smaller. It's 2% that you're earning on 300,000 versus paying 3.25% on the mortgage, right? So if you were to guess a number, what do you think that number would be? What do you think the total interest in 30 years on that 300,000 would be at just 2%?
Okay.
We won't count taxes. Yeah, we'll leave that part out.
Guys, whoever can Google the calculator first, just Google it and throw the number.
I'm just saying random numbers here. So, all right, you guys ready for it? Because a lot of times I get people saying, well, 3.25, if it's 170,000 at 2%, we'll say it's maybe about 130, 140,000, right? Here's the number. Here's the answer. Oops, if I can get it back on here. Here we go. $243,400.
Wow.
Remember, it was 170,000 at 3.25% for 30 years. So you're probably thinking like, what? Like, how's that possible? How is it 243,000 when you earned, really about 35, 40% less on the interest side? Well, that's where we talk about compounding versus simple interest. Remember, that 300,000 earning at 2% is compounding each year, because that first year, that 300,000, 2% then becomes 306,000. Well, now you're earning 2% on 306,000, right? Now it's 312,000 and change, right? It doesn't go up evenly. Now, the opposite is true with a mortgage, right? And there's no special formula here with the mortgage. What happens is that you're paying more than interest only. So you're paying down with some principal. Well, as that principal goes down, the interest doesn't change. It's still 3.25%, but it's that $300,000 balance. Say that by the next year, the balance now is about 295,000. Now you're only paying 3.25% on 295. Next year, maybe it's 285. You're paying 3.25% on that. So the interest goes down like that blue graph shows, while on the 300,000 is more like the green, it goes up over time. So here's what's crazy. What if you earned the same interest rate? 3.25% over 30 years on that 300,000 earns an extra 483,000, almost $500,000. Now, if you take out the 170,000, you're still left with about $313,000. I'd be okay with that. Again, that's only at 3.25%. What if we go up to 10%, right? What if you have money? And again, that's kind of a conservative figure I know for what you guys target on your fund. 10%, that means that 300,000 you use from your house. Yeah, it costs you 170,000, but in 30 years, that 300,000 now becomes 4.9, almost $5 million. That's huge, right? Even at 15%, look, it becomes almost $20 million. Do you think I give a rat's butt that I'm paying 170,000 on my mortgage when I know I can earn at least 10, 20, 30 plus $million off of that 300,000? No, of course not. That's why the banks do the same thing to us, right? That's why they always borrow money from us in the form of savings accounts or in the form of you paying extra principal on your mortgage so they have more money to lend out and accelerate. That's acceleration. You understand this concept that interest rates are not the same. When you have accumulating, when you have that compounding interest, it's not the same as simple interest. Understand that key is why whole life insurance, especially when I talk about high cash whole life insurance, works. This is how it works actually in your favor as an investor to actually create more money than you would using your savings account. Because what we're really trying to do is create this supercharged tax-free savings account, right? Now, all we're doing is the same strategy you're probably already doing. You're probably taking the money that you have in savings or checking, you put it into the investment, and then you get returns. And if the returns aren't reinvested in the fund, say it's like in the income fund, for example, you're taking that income as income, right? You're taking that as your passive income there. Same exact thing, but all we're doing is we're just adding one little step by putting the life insurance in the middle. So when you have cash and savings, you move that into the life insurance. Then what we do is we take a loan from the policy. And really when you're taking a loan from the policy, you're taking a loan from the insurance company like they're the bank. So you borrow from the insurance company, and usually if insurance companies charge right around 5 or 6%. Now at the same time though, as you see down here in that little green bubble, you're earning tax-free dividends on this money. And right now, most companies are paying at least 5 or 6% of that money, right? That's currently, and that's actually been the lowest it's been in decades because the interest rates are so stinking low right now. But what you're doing is you're borrowing from the insurance company, you're putting that into the investment, right? Now, when you borrow from the insurance company, your money's still in there. So say you have $500,000 sitting in this cash policy, you borrow $100,000. Here's the thing. You still have the 500,000 earning these tax-free dividends right here. So all of it's still earning. Even if you borrowed 400,000 of the 500,000, still all 500,000 is earning money in here, earning interest. While yes, you're paying interest on that loan, you're also earning compounding interest that's beating the interest they're charging you on the loan. So this is key because remember, if you use a savings account, you have 500,000, you pull out 400,000 and invest it. Now you only have 100,000 and they're earning that piddly little 0.nothing% interest in the bank, right? Here, we're using this instead as this tax-free way to be able to leverage the money, be able to borrow it. And by the way, when you borrow money from the insurance company, you pay it back however, whenever you want. So you don't even have to pay monthly payments if you don't want to. They'll charge you interest. So you got to be careful not to let it compound against you. But you can actually pay it back however, whenever you want. The balloon payment, if you were to call it that, is due at death. And all they do is they just take that out of your death benefit and pay your family the rest tax-free. So all we're doing is we're just taking that money from the policy instead from your savings, putting that into the investment. The cash flow, the returns from that investment comes back towards the policy to start paying down that line of credit. So then you use it again, kind of like what some people will call velocity banking, where they use their home equity line of credit. They run it up to invest, then they pay it down the returns of the investment, and then they run it up again, and then they pay it down with the cash flow. Same thing. The difference is here is that it's safer, because if you do that with a home equity line of credit, one, home equity line of credit does not pay you interest. This does. And then two, the banks can pull away your line of credit whenever they feel like, if you do that, use your home equity line of credit. This, they do not, because they know it's secured, it's guaranteed, it doesn't ever lose money. Other things, like I mentioned, it's tax-free. This is much like a Roth IRA, but without all the limits to it. So you put it in with after-tax dollars, it grows tax-free, and the money comes out tax-free. The cool thing is, in most states, California is kind of the one exception. They're not great, but in almost every state in the country, it's protected 100% from creditors and lawsuits. So even if somebody sues you and wins, they can't get to this cash. Even if you have millions stored in here, they can't touch it. Also guaranteed growth, like I said, about at least a guarantee of currently 4%, sometimes more. In fact, most companies I use have been paying dividends for at least 100 years straight, even through recessions, depressions, world wars, and everything. They've always paid a dividend, right? So that's key here. And I'll get to some of your questions here in just a little bit. So again, guaranteed 4 to 5% plus average, that's net return if you do it right. No stupid limits or penalties. So there's no 59.5 rule where if you pull out before 59.5, they charge you a 10% penalty. In fact, when you borrow, they just charge you interest. There's no origination costs or fees. It's just simple interest that they're charging you here. But yeah, no limits either. So for some of us, we can't even qualify to put money in a Roth IRA. No problem. We can use this and get the same tax benefits, but no 59.5 rule, no limits there. We can put in pretty much almost as much money as you want. That's the thing that's amazing. It's not like $6,000 or $7,000 a year that you're limited to, like with the Roth, and that will never get you to financial freedom. Here, you can put in up to 25% of your stated gross annual income, your stated income. So they don't even check for paycheck stubs or anything like that. They don't report anything to the IRS, of course, because it's tax-free. So if you're saying, hey, I make $500,000 a year, great. You could put in $125,000 a year, completely sheltering that from lawsuits, creditors, taxes, you name it. There's bank leverage. That's something we'll talk about as well. You can borrow from this. I mentioned you borrow from insurance companies at 5 or 6%. Well, once you get over a certain amount, like $50,000 or $100,000 in here, you can actually borrow from banks where, like currently right now, I have a bank line of credit at 3.25%. It's at prime. Technically it's prime minus a half, but they bottom it out at 3.25%. So even if they raise rates, I'm still kept at a really low rate. I only have to pay 3.25% while it's paying me with my current policy almost 6% right now. So, I mean, imagine the interest difference. It's massive. In fact, way bigger than the numbers I'm going to show you here. And of course, you get access to cash today. You don't have to wait 20 years to access this money. The way that we do it differently with this max ROI infinite banking, as I call it, is you can access it actually within the first month. You can get to the cash here. So let's use an example. And I just use an example of somebody buying some real estate properties, right? Really simple stuff. I looked up some real single family homes and duplexes that at a turnkey company that I work with, that I've bought properties from. Total down payment is about $95,000, right? Cash flow on those after fees and everything else, and paying the property manager and everything else, it's about $1,070 a month was the net cash flow on this. So here's the thing. I took a scenario saying, what if I had $100,000 in a savings account versus $100,000 in life insurance? And we compared it. What if we pulled out $95,000, $100,000 from savings account and invested it and did that and took the cash flow and paid it back to build your cash back up again, versus having $100,000 my whole life, borrowing 95,000 because you can access up to 95%, or in some cases 100% of the cash that's in there, borrow 95,000 of it, and then use the same cash flow to pay it back to the life insurance. So either we use the cash flow going to savings, or the cash flow goes back to that line of credit with your life insurance. Here's the difference. So down payment using savings after just 9 years, of course, most of it's just building that cash flow back up because you're not earning a whole lot. And by the way, I did this at 0.2% of a savings account. So this is higher than my bank at 0.05% is paying me, right? So at 0.2%, after 9 years, you had built it up to $121,000. That's what you built it back up to. So now you're a little bit higher than you were before because the property paid for itself and then some. So that total ROI is about a 0.7%, above the principal that you earned, or that you had in there. So there you go. So it only earned about 0.7% on the interest side. Check this out. Using the whole life, same exact thing, scenario. Now I actually have 178,000 after 9 years. And this is actually using my policy here as an example. Now, 178,000. By the way, if you're younger or if you're a woman and you're the same age as me, you'll get better numbers than I get, just so you know. So women live longer, so they get better numbers than men. And if you're, of course, younger than 44, like I am now, you also get better numbers than me, even the way I design them. I design these just the same way I design my own policy. But 178,000, so 47.5% ROI. It's a difference of about $56,000 over those 9 years. I mean, for some of you, that's a whole nother investment you could turn over and make some money off of. That could generate easily $5,000, $6,000 more a year for you in passive income in just those 9 years, doing the same stupid strategy you would do with your savings account, but using your life insurance. Oh yeah, and as a benefit, it's just it's almost a perk now. You have a death benefit with the life insurance. We're not even talking about the death benefit. We're just talking about how to use this as a supercharged tax-free savings account. So that's what we're talking about here, is using that money, flowing it through, having the returns come through, and it works great. So that's how you make money twice. So I'll show you some examples here. I've had somebody who is one of the best infinite banking people out there, and I noticed he used one of the companies I used. So I did an apples-to-apples comparison here with his. He purports having the best, infinite banking policy there is. Well, that's his on the left. Mine's on the right. Now, it's not a huge difference in the first year, but I still come out with $100 more. The cool thing is by year 7, although he's got just shy of 52,000, mine's over 60,000 there in year 7. And so that's the thing I try to do is, and also the minimum on it is less too. So I try to get that max ROI possible. Some people even ask me about what about index universal life, right? Can I use IULs? In fact, just before this call, I actually had somebody email me saying, hey, somebody sent me this. What do you think? And I'll tell you one thing, other than these bullet points right here, I showed them the numbers. I said, well, one, I actually worked with that company. I could offer you that same thing, but I'm not going to, because here's what the whole life will do. The whole life, by the way, in 19 years, even though he's only putting in 12,000 a year, made $100,000 difference in mine versus the other guy using an IUL with projected possible stock market returns. It wasn't even like guaranteed returns. It was just possible stock market returns. So one, usually IULs just off that alone, even if they try to purport that they have higher returns in the stock market. But two, here's the big thing. You can't double dip. If you borrow from an index universal life policy, guess what? That money will not be earning interest. You won't be paying interest. They'll try to wash it out to where you pay no interest on that money, but you won't earn any interest. So if you have that same example, you have 500,000 in there, you borrow 400,000, only 100,000 of your IUL is going to be earning interest, just like the savings account. So it really loses that magic, right? Also, IULs get more expensive over time, so costs go up, and there's just no certainty. If you don't get any good market returns and costs are going up each year as you get older and older, it could actually start eating the cash out of that policy to where you start losing money and you have to put more money in just to keep it going. Whole life, you never have that issue. There's no stock market investing, nothing like that. It's guaranteed. It will always grow no matter what, even if you get the guaranteed 4%. Oh, by the way, that 4%, if you wait until next year, 2022, that goes down. They just made some law changes with the 7702 tax law back in December of last year, where the insurance companies said, hey, can we offer a lower guarantee than 4%? So the government allowed them to go down to 2% starting in 2022. If you already have one, if you already have a whole life policy, you're safe. Like those tax law changes, unlike IRAs and 401ks, when they change tax laws, you have to go with it. With life insurance, their contracts, you're grandfathered in. So whatever the tax rules were at the time you got it, that's locked in. So if you already have a policy, you're safe. If you get one in 2021, you're safe. Once we hit 2022, the guarantees go from 4% down to 2% with every company. So kind of little side note. Here's an example, somebody doing an IUL, right? 12,000 a year. Wasn't the same one I was mentioning, but it's kind of the same point. It's funny because if you think about this, this IUL, it takes you, let's see, how long is it before? Actually, this is very similar. It's very similar to the one I was actually just showing today, funny enough. But you'll see here, it takes nearly 20 years before you finally, it's over 15 years before you finally break even on the cost, right? It's about, 15 years in, you break even on the cost. On mine, you usually do it with, if you don't do it within 5 years, if you do higher amounts, you'll do it in 5 years. Otherwise, it takes about 6 years to break even, not 15. So who's this not for? If you're in horrible health or you're a smoker, this isn't going to work for you as well. The numbers are horrible, right? They're not going to be great. If you're over the age of 70, probably not as good, even though you can still do it, but it's not going to be as great. But for the most part, if you're health, at least in average health, and you're under the age of 70, this can work great. It can still work. It may not work great if you're already in the point of retirement and you don't have a lot of extra cash. That's the other thing too. If you're paycheck to paycheck, which I would imagine none of you probably are right now, but you might be if that's the case. If you're paycheck to paycheck, I just tell people get term insurance for now, and then you can convert it later when cash flow is better. But that's generally who it's not for. Those that either can't do at least 5,000-10,000 a year into something like this. If you're not able to save any money really, because you just don't have any extra left over every month, or you're in a situation where you're over 70 or in bad health. I did have a guy, he was actually a dentist. He was in really bad health in the sense that he was 400 pounds over in bad health. So for him, he knew, especially him being in his 50s, it wasn't gonna be great, but his wife was in great health. So instead we started putting over $100,000 a year into her plan instead of his, get a much better return. And then he's leveraging her life insurance to go and invest and do this double dipping. So there's lots of ways to do it. Ways to use this, you can use it as an emergency fund, because a lot of people will say, okay, I'm trying to keep 6 or 12 months of expenses reserved that I don't touch, right? Just in case something happens, I lose income or something like that happens. Well, the worst thing is you have that money just sitting there in a bank earning 0.nothing%, right? So what I do, and this is the same case with me, my wife said, I need 200,000 sitting in a savings account, Chris, no less than 200,000. I said, well, I don't want 200,000 earning nothing, because in the bank at 0.05% of my credit union, plus I get taxed on that 0.05%, does not make me happy, right? And even an online savings account like with Capital One pays me a whopping 0.4% that I then get taxed on. So I said, all right, let's make a deal. Let's earmark 2/3 of this money. So about $130,000 of the life insurance, we earmark that we don't touch. We just leave as emergency fund, right? The other 60 or 70,000, great. That can be in banks or online banks or wherever it might be. We can put it there. But at least this way, because it does take me about a week to get to the money here. If you're wondering how long it takes to get the money, it takes about a week or so from the time you request it. So you still want to have money in the bank that you can walk into today to get it out. But here I can put the bulk of my cash in this and still be able to make a much better return that's tax-free and again, protected from lawsuits and creditors, right? Using it for cash flowing investments is always great. I would even add to that short-term investments or investments that at least pay on a regular basis. So if you're in a fund, not saying any fund in particular, like we have said many times, you get paid on a quarterly basis, great. This works wonderful with that. If you have quarterly dividends or even if it's annual dividends, it will still work. But if it's something that doesn't pay you out for like 10 years, maybe not use this. Maybe just use cash for that. But definitely cash flow investments, even short term. I have people that do a lot of fix and flips on their properties. This is a great way to use it for that. Collateral is another way you can use it. I'll give you an example. I had a doctor that wanted to buy his own practice building. He was out in Minnesota. The building with the build out and everything was going to be $375,000 to purchase it and then build it out for him. Well, he had $310,000 sitting in his life insurance. So he asked me, he said, Chris, I have this life insurance. I haven't really touched it or anything for years. I think I'm just going to cash it out and use that to buy the property. What do you think? And I said, and even though it wasn't a plan I set up, and even though it wasn't great, I said, you know what? Let's not do that. Instead, let's go to your local bank or credit union and ask them if they'll do a secured line of credit using this as their collateral, right? Because this is just like money in a savings account. You can get a line of credit against it, and with collateral, they'll give you a lower interest rate. And back at that time, this was in the mid 2010s. It was like 2015, 2016. The rate for buildings was right around 5 to 6%. So he went to his credit union and he said, hey, would you use this as collateral? They said yes. So they gave him $375,000, even though it was only $310,000, they gave him $375,000 for the loan at 3.25% and $1,800 a month. So dirt cheap for a building of that price. So he went and he built it out, even got renters in, so it started to cash flow. And then he went back to the bank a year and a half later, said, hey, can I now take this lien off my life insurance? Can we, because now the building's been built out, does it have enough value that we could take this lien off? And they went and ran the numbers. They said, yep. And guess what? We'll keep the same interest rate and the same payment. So they didn't change the terms at all. They gave him the same terms, but now the building is collateral versus his life insurance, freeing up $300,000 to invest however the heck he wants. So you can be used as collateral. You could pay off loans with it. If people are like trying to consolidate, pay off high interest loans, you can do that. I don't recommend, by the way, this is one thing that infinite banking people will teach out there that I think is a myth you shouldn't do, is do not go buy your own home or cars using this as your thing. Because a lot of those infinite banker people will tell you, yeah, you pay yourself back. But remember, I said, you don't pay yourself back. You're paying back to the insurance company like they're the bank. It's still an interest being charged. So why would I pay 5% when I know I can go to the bank and on my mortgage? I actually just did this for $1 million plus mortgage. Is 2.75% for a 30-year mortgage, and I can get a 2 to 3% loan on my car loans. So I'm not going to use my life insurance for things that the bank will give me cheap money for. Even my investment properties, I'll get a mortgage on my investment properties, but the down payments, the things I can't get a loan for, that is what I use this money for. I'll use this for the down payment on the properties. I'll leverage the bank to get all the cheap money I could possibly get from them. So I hope that makes sense. Extra retirement income. I know Mike has talked about this before when we've done podcasts, but definitely you can use this as a supplemental retirement. Even though we're talking about creating and investing with us now, so you get the retirement much sooner than what you would just using life insurance. And you can even use it for kids as savings. I just did a podcast last week that I released talking about 529 plans. The problem with 529 plans is that you have no control, right? You're kind of limited on how much you put in anyways. But the problem is that they kind of make it strict. The younger you are, the more they keep you in the stock market. So if the stock market tanks, well, that's not good because now you've lost money. Well, as the market might recover, remember, as your child gets older, they start taking more and more out of the stock market, going into conservative funds. So what might happen is that even though it might tank, if it's at the wrong time, it tanks and then it only slowly comes back to where you were, putting you at additional risk. Plus, what if your kids get scholarships, or what if they don't need it, or maybe they don't go to college, maybe they become an entrepreneur, or they do something else in vocational trades. You can't use a 529 plan for those. So life insurance can be the option where you can actually use this however, whenever you want. I have one guy, he's a veterinarian, that he actually pooled both of his sons' policies together. And you can only put in about 5 to 10 or 12 grand a year max into your kids' policies. But he does take their money, puts it together, and he goes and buys properties with it. And so he's using that as a way to fund their future, whether they go to college or not. Could even be it could even be a wedding gift down the road, right? Again, you control the money. It's all your choice. So lots of different ways you can use this, of course. So that's the main thing that, I would say is like, why wouldn't you use it? I'll say this as a by the way, and then we'll go to your questions right now, because I'm going to open up for questions. So any questions, go ahead and start putting that in the chat. There are strategies you can even use if you have at least $5 million of net worth, and that even includes your home equity, where accredited investors don't count that. Home equity, value of your businesses and things like that. There are some other longer term strategies you can use where you can actually get essentially an infinite rate of return on your money, almost create this like 20-year pension using life insurance where banks will pay the premiums for you. So not good for the short term. It doesn't work for the short term like we're talking about here with investing in the here and now. But if you have at least $5 million of net worth with businesses, real estate, home equity, everything, there's another option as well to do that with a totally different subject. Not even going to go down that little rabbit hole. So we'll stop there. How's that sound?
Oh, sounds great. Sounds great. Thank you, Chris. This was amazing. So first, more or less admin question. Will you be able to make this PowerPoint presentation available to our audience?
Yeah, I can definitely email it to you and then you can distribute it however you need. Yeah.
Thank you. That sounds good. There's another question in the chat and I can read that. Where the guaranteed returns come from? How insurance generates this percentage to pass to you? sorry, I joined late. Maybe you covered it already. What is the insurance company that Chris works with?
Yeah, all great questions. So the guaranteed interest rate comes from, they always budget out what's called a return of premium. That's one of the reasons why it's tax-free, right? They always budget in that they're going to return money, especially if you use it with a mutual company. Mutual companies are much like credit unions. If you think about banks, banks have stock shareholders, right, that they pay their profits to, where a credit union says, hey, we pay back to our members, right? So they pay it back usually in the form of better interest rates. Well, mutual companies are the same way. When you have a mutual company like Mass Mutual, Penn Mutual, Guardian is another one, anything with, the word mutual on the back end, especially, are companies where there are no shareholders. So the people that own the life insurance policies are essentially the owners or the kind of the board members of the company. So all the profits go back to you. So the guarantee comes from the return of premium that they just know that they always overestimate in case there's some catastrophic event, right? Something that's much bigger. Funny enough, COVID did nothing to it. In fact, people actually lived longer during COVID. People were better in 2020 than they were in 2019. Funny enough, I don't know how that works, but apparently people did better during 2020. So people always say, oh, is it going to get worse? Nope, that didn't affect dividends at all. In fact, even if somebody's had COVID, it doesn't even affect their health rating, when they get judged on it. So that's where the guarantee comes from. The other place you get dividends from as well. So that's the guarantee, the 4%. Anything above it, like one of the companies that I have a policy with is at 5.75%. Well, that also comes from them investing their money too. So 3 ways you get paid. One is return of premium. 2 is, if it's a mutual company, the company's profits. So if the company's profitable from new clients and things like that, you make money. By the way, when people buy term insurance, you make the most money because term insurances almost never pay out. They say that depending on which company you ask, most of the time it's usually 0.5% of all term policies ever pay out. So for an insurance company, they're pure profit. They're almost virtually all profit for them. So all the people that buy term insurance policies, you're the one that gets to get paid the profits on that in the dividends that you earn. And then the third way is they have a portfolio. So the cash that you have in there, they're investing in different things, usually things like bonds, which is why the rates have come down over time. They also have things you invest in like mortgage-backed securities and things of that nature. They don't really do anything with stock markets. They stay out of that. They stay more just treasuries and things that are really just certain, right? So that's where they pay the returns from. That becomes part of your dividend. How insurance generates this percentage to pass to you. I don't know if I covered that already or not. I'm not sure I understand the question, but if I answered it, great. What companies do I work with? I work with several. I mentioned like Mass Mutual, Penn Mutual, Guardian. I call them the big 3. Those are the best ones for the infinite banking type stuff. Even other companies like Ohio National, Emeritus. That was the one that guy sent me. So I said, hey, I actually am with that company and I wouldn't give that as an option to you because it sucks. So there's lots of options, lots of companies. Security Mutual is another one. Several companies I've used and some that I don't use at all because they're just not competitive right now. But I keep them in the wings just in case. If they get more competitive, I can switch, right?
And Chris, on that note, you said could be 3, 4, 5 companies. So how do you decide which one to choose? Is it a matter of rates or is there more to it?
It's really not. Yeah, it's not even about the dividend rate. The number one factor is how much can I reduce the costs? How much flexibility does the company give me to reduce the cost so you get a bigger return? Yeah, it's funny because like Mass Mutual, right, is it's probably like my second most used company. The first one I use is Penn Mutual. Now, Mass Mutual I use for my New York clients because Penn Mutual and like most insurance companies aren't allowed in New York. You guys are like your own country, right? So Mass Mutual I use for all my New York clients, and they're a good second place. But the funny thing is Mass Mutual pays a higher dividend. They're paying 6%, while Penn Mutual pays 5.75. Well, how is it that Penn Mutual will beat and can even crush Mass Mutual's numbers? Well, it's because I can lower the insurance cost more. They give me more flexibility to reduce the premiums and make a bigger spread. So that's the thing I always do. I always guarantee that I'm going to get the best ROI because I can get the lowest, the most flexibility. Even when they make these insurance changes, like all the insurance law changes and they change the minimums and everything, I guarantee I'm going to be running them and competing them against each other again in 2022, saying, all right, who comes out better? Who's got the better product right now that will give people the best return? But here's the key. The costs is the number one factor for giving you the best return. Because if one company can offer costs that are 10% less than the other company, I can guarantee that company is not going to pay a 15 or 16% dividend to try to offset that, right? Because there's no companies paying more than about 6% right now, right? Just because the rates are so low. 20 years ago, they're paying over 10, but they're just not doing that today. So the cost is the number one factor you have to look for.
And they,
Michael, I think.
And yeah, on the cost, and I'm sorry I'm interrupting, but can the costs be negotiated? If you continuously bring in clients, let's say to Penn Mutual, would you be able to negotiate the costs?
No, I can't. It's pretty set. So it's, I mean, I basically run, like I said, I run every client just like I run my own policy. So I can't do it with volume or anything like that. And that's because there are some tax limitations, right? So when I set up these policies, what I really am doing is I'm having you overfund above the minimum is what I'm doing, right? Because if you just pay the minimum into a whole life policy, it takes years to make money. I mean, you have to wait till the third year before there's cash that shows up in there, right? Because most whole life policies, most insurance agents that sell these, and the reason why they have a bad reputation online and everywhere else, even with Dave Ramsey's and Susie Orman's, is because, and I agree with them, by the way, I think this is bad, is that whole life and the basic type of policy that you have, the first 2 years, all of your money goes to insurance costs, all of it. By the way, that's what insurance agents get paid on. I found this out, especially during 2008, right? I actually lost my policies because I bought from a guy who sold me whole life that did that same thing. For the first 2 years, there's no cash. By year 3, when the recession hit, I finally started to get a few $100s of cash after putting in 25 grand. And then I couldn't afford to pay the premiums anymore. I lost the policy after putting in $25,000. And I found out that he could have designed it differently, like the way I do it now. And I debated with him. I actually showed him numbers, showed him everything. I said, why didn't you do this? And after I shot down all of his little debates, items that he had, he finally just said, Chris, I don't do that because I can't cut my commissions. I can't afford to cut my commissions. Because then in his mind, he would cut it back so much. The funny thing is that I'm only doing this, I'm semi-retired, right? I only do this part-time. I make way more money than he's ever made in life insurance because again, we're doing it the right way. So that's the thing is like, I can only do it to the tax-free limits. So if someone says, I want to put the max at 50,000 a year, I do it to where we get the minimum death benefit needed to allow 50,000 a year to go in. But here's the thing. If you put it 50,002 cents, all of a sudden it goes from tax-free to an IRA status. So it becomes taxable. So we want to avoid that. They call it a MEC or a modified endowment contract. You don't want to get in that place. So we try to make sure that we always get it right up to that max, right up to that line, but we don't go over it to keep it tax-free, but we keep the cost very low. Cool thing is, even if you put the max at 50,000, your minimum might only be like 12 or 13,000. So even if you can't pay the maximum 1 year, great. Well, then just pay at least the minimum. And even if you can't pay the minimum, you can just borrow from the cash to pay the minimum for you. And it usually grows by itself by the third year. Like pretty much everything you pay into it, it's growing without you putting money in by the second or third year.
Amazing. And next question is from Michael. What is the risk this company to lose premium or even go bankrupt?
Awesome question. Funny enough, these are actually safer than FDIC, than banks, because FDIC, if you actually research it, they only have about 2.5% of our total savings that can be protected. If banks start to go, say 10% of banks go out of business and go bankrupt, you might be waiting for your cash because the FDIC doesn't have that much in savings. With life insurance companies, it's different. One, life insurance companies can't loan out anything they don't have. So unlike banks, they can't over leverage themselves. So they don't go to bankrupt that often. In fact, in the Great Depression, only 4 insurance companies went out of business, while half of banks went bankrupt. But even in the rare cases when life insurance companies do go bankrupt, guess what? They're all legally required to get what's called, I just blanked out because I read your comment at the same time, so I multitasked. They buy what's called reinsurance. So there's global worldwide companies called reinsurance companies that insure insurance companies from going defunct. So if they do, these reinsurance companies step in, make sure that your cash value and your death benefit is guaranteed. At least either they'll take it over or they'll wait till some other insurance company comes and buys your policies and then they take it over, but you still get to keep the same policy, the same terms and everything. So it's protected. So Michael, to answer your question, the risk is very, very low. Of course, barring the fact that there could be massive Armageddon and everything, the entire financial system collapses, that's when you finally lose your money. How to compare annuities versus life insurance for 10 years as a retirement supplement. It depends. If you're just comparing apples to apples, I mean, annuities could be better than life insurance if you're just using those alone. Here's the thing I would tell you. I've never seen an annuity or life insurance or a mutual fund for that matter that will ever get you to be fully financially free, right? You just can't. It's almost impossible to save up enough to get to that place unless you want to live like a pauper. You want to live broke, dirt cheap. However, if you want to be able to use the life insurance where you do go and invest, like if you're doing something with the Tempo Fund and things like that, then there's no comparison. Annuities can't compete, right? Because the annuities, they're going to be doing their own thing, where with life insurance, we can invest it wherever we want. And that's another great thing too. Unlike self-directed IRAs, where there are some limitations where you can invest it, life insurance doesn't have that issue because the things you invest in is not inside the life insurance policy. The life insurance, the cash value is growing tax-free, but the investments you're doing over here, completely separate, just like you did it in cash. So it's just like using savings, but you get this added benefit of being able to invest it and make it grow here at the same time. So that's how it can be an annuity. But if you're just doing life insurance for life insurance sake versus annuities, likelihood is annuities probably going to end up doing better as long as it's not tied to the stock market and the market drops at that very moment you get in.
Yeah,
great questions.
Yeah, no, it is amazing questions. Chris, while we're waiting for more questions, do you mind putting up your contact information for anyone who wants to reach out to you?
Yeah, absolutely. I'll put in my website my website that you can use.
Sure.
You can just go there. There's a contact us page. You can just go right to. So moneyripples.com is the website. Of course, I always invite you to go check out the podcast, the Chris Miles Money Show, where I cover a lot of different topics, including this one from time to time, but I cover a lot more about investing, passive income, and so forth.
Is the link to podcast on your website as well?
Yeah, you can actually go there, or you can just look it up on iTunes, YouTube, Audible. I mean, any platform you use to watch or listen to podcasts, you can just search the Chris Miles Money Show and you'll find it.
Sure. Chris, you mentioned something about term policy offering potentially higher dividends than the whole life. But in order for people to utilize life insurance policy, it sounds like whole life is a better product. So does it still make sense to compare the two? Or if the folks are interested in double dipping, if you will, they should only look at the whole life?
Yeah, the double dip is only available with the whole life. That's the only tool that you can use to make that work. Of course, you can always do the other ones, right? But I just haven't seen a reason. The only time I've used like index universal life is for two things. One is somebody that's over the age of 70. Sometimes we'll get like a guaranteed universal life where it's almost like a term premium, but unlike term where it'll end by your 80s usually at the latest, this one will go your whole life. So I've had some people where we said, well, we want to keep it cheap. They just want the death benefit. Great. We do a guaranteed universal life because we don't worry about the cash value. If you're looking to invest and do stuff, like especially in this alternative space, whole life is really the better tool. And even the other one I talked about a little bit, that infinite ROI type of pension, that you can create where the banks pay the premiums for you. Again, I mean, that's a longer term thing. That's 20 plus years before you're really able to access the money. This is really best used if you're investing right now.
Gotcha. Perfect. Awesome. Thank you. Folks, any additional final questions? We have about 10 minutes left with Chris. If not, then on Chris's website, Money Ripples, there is his contact information. So definitely feel free to reach out. As Chris mentioned, he's been on Mike's podcast, so you can find his interview there as well. And if you happen to have some questions after this webinar is over, definitely send Chris an email and connect with him offline. Chris, thank you so much. This has been amazing. We really enjoyed it. This was very informative, brief, and easy to follow. So thank you so much for your presentation, and we look forward to doing another one sometime in the future.
Such a pleasure, Lena. Really appreciate you having me on today.
Thank you. Have a good night, everyone. Bye, guys.
Good night.